This meeting is now live. This is Value After Hours. I'm Tobias Carlisle, joined as always by Jake Taylor. Our special guests today are the Seawolf gents, Porter Collins, Vincent Daniel. How are you?
Doing well.
Yeah, we're good.
No complaints.
Good to see you boys again.
Yeah.
It's very good to see you guys again. What is going on in the market?
Easy question.
Let's just start there. Give you a
Porter,
softball to
you
start.
start first on that one. Go.
Well, I said this morning, I think the whole world is now on the same side of the boat. I think the whole world has figured out that we are in some sort of soft landing, inflation's coming down, the Fed's going to cut rates and save everything. And I think that's it. I probably disagree with that. I don't know if I disagree with it, but I think that the long-term rates are going to have a harder time coming down. That's generally my view, and I don't know if I'm all that bearish on the market per se. I just think you got to really pick your spots and growth. We've just been talking about this. Growth has had an unbelievable run this year, and it's back to the growth versus values, back again to its absolute highs versus value that peaked in during the pandemic and then peaked again at the end of 21. So I just think it's going to be a large task for the S&P and for growth to really keep going from here. You know, the Apple's multiple has gone from 20 to 32 times this year. That's the market, right? It's been all large cap growth. And so, of course, people who don't really play in large cap growth, it feels a little bit different to us. And so, I think we like a lot of stuff. We think, we look for value. We look for margin of safety. We look at this stuff, and a lot of stuff we see we like. The harder stuff is the catalyst and what's going to happen from here. So I actually think that people want inflation to come down so the Fed can cut. The problem with that is that a lot of the earnings growth has been because of inflation, right? Because of being able to raise price. And so
yeah, it's not unit volumes.
Yeah. And volumes have stunk, and I think that's because the consumer is stretched, and they don't like the price on the screen or anywhere else. So, I think that probably growth is going to be a little bit slower than people think next year. Nothing disastrous, maybe, but we'll see. I don't think you're not getting a bargain buying the S&P here.
What do you make of that three peaks for like the growth rally again this year? After, if you look back at 2000, it ran up once and then it collapsed. And this time we've had three in a row. We're back now as stretched as it's been. What drives that?
I think it's liquidity, to be honest. I think it's liquidity, and I think you've had a non-tightening central bank policy since October of 2022, generally speaking. So they were tightening in narrative and on tweaks on the margin, but in general, I think they allowed liquidity to run free again, or run freer, not super free. The catalyst, I think we've said this before in the past, I think the catalyst that created that was concern over what happened in the UK in terms of their pension. I think there was also a concern, there have been concerns, and rightfully so, about the US banks as well as the debt and the deficit. So I think in general, while they've had a tightening narrative bias, I think they've had a loosening when we need to. I think the market picked up on it. And when you allow the pipes to flow water into the equity capital market system, that liquidity, those flows, that leverage finds itself in large cap mega tech companies. So I think that's what we had, which then begs the question, are we going to continue to have that in 2024? And the answer is maybe, right? Because to a certain extent, as the one thing I wanted to talk about during this podcast more because I'm so non-committed in terms of what's going to happen from an economic perspective in 2024. I'd rather talk about the variable that I think is the most important one. And now is the time we have to start talking about it, is the election. It is such a big dynamic that I think is going to have such an impact on markets. And I'm not saying bullish or bearish. I'm just saying, because it's very path dependent how it happens. But I think the election is going to be a talking point for all of us over the next 9 to 10 months. And we could start talking about it now. It's just talking about the potential paths it can take.
The other thing I would say about the why is the growth versus value different now versus 2000? I think that you've had these companies, whether it's Amazon, and Amazon's destroyed, almost everybody else on the planet in terms of retail, right? Look at the infrastructure they have. They spent 20 years buying planes, buying cars, buying, factories. The AI they've built, been able to, map routes of drivers, being able to, get all these products for people, and so they've just destroyed everybody else. And they deliver more packages than UPS and FedEx. I mean, it's simply amazing what they've done, right? And so you've had this real concentration at the top of these big companies, and they've just kind of killed everybody else. That's why I think that the step level is so much bigger than it was in 2000. From here, though, I think in this more recent range, growth again is at the top of this, growth versus values at the top of this range. I think it's going to, and like I said, everyone's loaded in these AI growth names. I think it's going to be, usually the market messes with people, and it's going to mess with people again, I think.
I saw that hedge funds are pretty well tipped completely into the Mag 7 right now.
Yeah, and it's worked. And it's working, right? So
one of the things I was telling my guys we used to work with, and saying, I've always looked forward to upcoming idea dinners, particularly towards the end of the year. And keep in mind, we made our bones in the financial services industry, and I told them, stop going to these FIG-only idea dinners, because who needs to know who's long Bank of America versus short Goldman Sachs or vice versa? It doesn't really matter. Not only that, most of the people that speak at these conferences are so couched in this crowding factor that they're really not probably telling you exactly what they're going to do. Instead, go to a generalist or a macro. Go to many. And I'm just trying to rewind the clock a year ago, and put us in this camp as well. Everyone, the sentiment last year was the world sucks. The S&P has to go to 3,200, right? And at 3,200, maybe you can buy the market. And we're also short tech, but we're long energy. That was generally the prevailing sentiment, and it was as wrong can be. I'd love to know and I told them, just go to every dinner and walk away and find out what sentiment is, if there's a prevailing sentiment or not. And I don't know if there is at this point in time, but just try and figure it out. And no matter how much you agree with it, no matter how much it feels good to you, don't do it if you're with the crowd, because it's probably more likely than not going to work. So I don't know what the sentiment consensus is. If I had to bias, I feel like people are expecting some form of an immaculate recovery, which is somehow, some way, we get 100 basis points of rate cuts, yet nominal growth really doesn't slow down all that much. And yeah, we know it's not going to last that long, but it's going to feel really good for 4 months type of feel. But I can't say that I feel that as strongly as what it felt last year in terms of what sentiment is right now.
I just don't think Powell's cutting like everyone, like the market assumes. I don't think that's going to happen. Could the market retest the highs? It's only 4% from here, so that's not that big of a stretch. So could you see the retest of highs? Probably. I think from there, I think it's going to be a bigger battle. We were before we started, we were talking about back to our screens of what we see, and back to I'll call it what the acquires multiple screen that we've named on our Bloomberg here, and it looks awful usually, right? But it's the only companies that are included are, of course, the two Ford and GM, Alibaba, every international oil company, and some rogue shipping companies. Well, not rogue, most of the shipping companies. And
They're all
so,
rogues.
All rogue.
all rogue. I mean, the funny thing is that all those balance sheets are unbelievable, right? Look at Alibaba's balance sheets, fantastic. Look at the international oil companies' balance sheets; they're really good. Look at the shipping companies; it's ridiculous. Like, people hate. One of them is on there. We don't own it, but we used to. Is this company Danaos, DAC, DAC? And if you just look at what the debt and the cash have done over time, it's just they've gone like this, and everyone's bearish on shipping and volumes, and they've just quietly totally reversed the course on their balance sheet, and it's really good. And so, we'll see what happens. A lot of the stuff that we like are idiosyncratic names where it's like we're still in this Peabody Energy BTU, but they're buying back 15% of the float a year at this point, right? And earnings are going to be better than people think this quarter. People are going to be better than they think in 2024. And so, we have a stock which we think beats earnings and buying 15% of the float back. And, the other one that we've owned for a while is AMR, right? The met coal producer. And, they've just shrunk the share count. And you see what the stock has done. It's gone, vertical, as just that they just narrowing the share count down. And I think that the value guys have learned this, or a lot of the value guys, that I can't get included into the gates of the S&P where my stock goes up every day and in an algo. I have to kind of control my own destiny, and so they have to bring the debt down to a level and build up the cash and say, hey, I'm just going to buy back my own stock. And the market's going to, and the acquirers multiple list is everything under 6 times EBIT, right? And if you're buying your stock back like Peabody is at 2.5 times EBITDA, that usually works.
Eventually.
You got to play the long game. You got to play the long game.
I mean, this is what Einhorn was lamenting, that you're not getting a multiple re-rating right away when you go buy your cheap thing. But yeah,
those days, in my opinion, and it's funny, I speak to friends and it's like, the stock picking market is coming back. I'm like, I don't think so. Right? Like, I really don't think so. I think it's going to take a market where flows stop coming in the door, which we all do not want, right? Or a change in rule of law, which probably is not going to happen unless the markets go down a heck of a lot and people figure out that market structure is a little weird and funky, but it's working for them right now. So rather than hope that I can buy something and it'll go up the next day because I saw value and other people will see value and so on and so on, I'd rather own the self-help stories that Porter was talking about. Whereas even if I don't have help coming my way in the form of other institutional or retail investors, management's doing the right things and has enough of a capital allocation strategy where it's really going to help you out. But it's an arbitrage that's not going to narrow in a day like your typical arbitrages. It's going to take a while. It could take a long time.
But back to the this acquires multiple list that we have. The interesting one on here are the Chinese stocks, to me, sort of intellectually. Alibaba's on here, JD.com's on here, Alibaba is arguably the cheapest large cap growth stock in the world, right? It's 4 and change times EBITDA, under 10 times earnings. Like, that's the interesting one. Like, whereas everyone thought that Meta was completely dead and gone, it did the V bottom and tripled off the bottom. So, sort of intellectually, we sort of look at it every quarter, watch it, and the earnings have been fine. It's just whatever it is that I don't know what it is, whatever algo it is, but it's been going down every day for a month and a half now. And maybe it's just the turn of the calendar. I don't know.
I think there's been a lot of institutional money leaving
Yep.
China as much as they can get out.
Yep. And so at a point that'll be like, okay, that's the selling is gone, right? Once the selling is gone, that's when guys like us, I mean, because essentially that's what we do, is we're value investors, but as a value investor, you have to look for the inflection point, because if you don't find the inflection point, you're just going to sit on some cheap bucket of whatever. And so, you have to finally see where the takeoff point is. And usually the markets are smart, and the guys and everyone else gets on board and buys these, inflection stocks. But like I said, like Vinny said, that there's most of the stock pickers are dead at this point.
The Silicon Valley Bank blew up earlier this year, supposedly because the Fed balance sheet was being shrunk. And then there was that, it bounced back up again when I don't know how that buy the BTFP or whatever that program was. I think that got included on their balance sheet. But I checked in on it again the other day. It looks like it's shrunk considerably beyond that point where it had been before, and it's now quite a bit smaller than it was then. Why is it that seems to be shrinking, and yet we do seem to have so much liquidity? And it's not just showing up in the stock market. You do see it in the stock market, but it's also housing's back to where it was, and we haven't seen any banks really blowing up. How can you reconcile those two ideas?
The interesting part about shorting and you need a margin call liquidity event, and you obviously got that where everyone pulled their cash and we're out of here. But what the Fed did is they put a floor underneath it, right? They said, this under our watch, this is never happening again, right? And so they allowed all the banks to go in and say, unlimited funds, here you go, never happening on our watch again. And so that put a floor in the market, right? Not the first time it's happened, but they did it again where, they don't want any cascading of asset prices, right? That's just off the table. And so, that program will fluctuate here and there depending on the capital markets now, I think.
But specific to the banks, what I think happened, at least in this is over the last 2-3 months, which is probably even more accelerated even more. With the decline in the 10-year, what are we going on now? 70, 80 basis points from the peak or close. That gave the banks the ability to trim their balance sheets on the security side, take losses, but not as severe as the losses they were going to take when the rates were materially higher, which then relieves you of the need for funding from your high cost funding, which is the BTFP and probably incremental deposits. So it's funny. One of the things that we talk about a lot in financials is I'm kind of scared to short traditional financials right now, because if we do have a period of time where we have a soft landing, right? The traditional regulated financials have underperformed the market for 2 years in a row by a decent amount.
One of the only groups in the S&P that's done that.
And they're not expensive by any stretch of the imagination. So if we have a period where the world seems okay, and I'm not sure I completely subscribe to that, but from an economic perspective, you could tell me an economic environment, and I might say to you, yeah, I could see that. Right? I'm so non-committed on the economic path, probably absent the extremes, that I could foresee a thing where the carry is outperforming the tape by 10% starting off the gate. And we all know how institutional managers who are hugging an index, and they're probably severely underweight, or underweight financials, it could create an upstream. Now, I don't love the financials, but from a technical or flow perspective, I'm scared to short.
Oh, they don't own. No one owns these things.
Nobody.
They dump them all at in the summertime, right, or in the springtime. So that's what I said. Like, usually where everyone's on one side of the boat, that's when the calendar turns. That's usually not the trade, right? Unless it's obvious earnings are going up, they're going to beat, we're going to keep going. It just doesn't feel that way.
Have you guys been dipping in financials or no? Just curious.
I've got a bank,
No.
but it's I'm a little bit wary. I've got one, and I don't love it, but that's okay. I don't love any of it.
Per grants, last 12 months, annualized rate of growth for the Federal Reserve Bank credit is minus 9.4%. So that's a decent amount of reduction on the balance sheet.
Yes. Yeah, and I don't think that's really where the credit skeletons lie. I mean, they will have elevated charge-offs. There's no doubt in my mind if that's the case. If we have something worse than a soft landing, but that's not really where the credit lies. It lies outside the banking system. So that's why I come back that if we have a harder landing, I would not want to own banks. I apologize for this, but you're pissing into the wind, right? Whereas if the economic tape is a little bit better, they have giddy up and go potential. There's coiled spring potential.
I'm looking at one of the other financials in here is Virtu, right? And you look at Virtu recently, the stock has sort of bottomed out and it's starting to go up again. And if there is some sort of volatility and volatility comes back again, that's a stock that's going to do well. And so you can see I can kind of see what your screen does. It sort of says like, hey, I know everyone else hates it, but I kind of like it. I kind of like because the balance sheet's good too. And so yeah,
I get to be wrong by myself.
that's all right.
We know the feeling. Yeah.
If the trade last year as we came into the year was long energy, short tech, is it the other way around now?
Well,
how do you feel about
see what's
energy?
happening with energy? People are freaking selling like crazy at this point.
What do you think of OPEC's prospects of actually controlling that? They always it was always when older versions of OPEC in the 80s and 90s that they always had defections. They would talk a good game and then.
Vinny and I have been bullish energy, but we were never $100 energy guys. We've always said that, hey, if energy stays from 65 to 85, that's a money. Sort of sweet spot for these companies, right? And
probably gone up a little bit more with inflationary costs, but still, typical contrarian us. Whenever oil gets to 100, I get scared.
Yeah,
on energy because the world doesn't like that.
When it goes to 65 and everyone's like, oh, it's going to 45. It's in there. It's like I don't know. I don't feel that. I don't get scared.
Yeah, but to answer your question, I don't know. Is OPEC losing control? Maybe. I
don't know if they ever have control. I think they talk a good game.
That's where I'm kind of. Did they ever really have tremendous control? What seems to be the issue right now is that the Americans in Porter's neck of the woods and down in Texas are drilling like mad, right? And it's probably mostly the privates where, once again, we don't have the history in this sector as like we do financials, but once again, like they did in 13, 14, 15, regardless of where the price of oil dropped, they are dropping the rig count, but the actual output and production is staying high. I think unlike 13, 14, 15, I don't see a tremendous growth surge in the reserves that are underneath the ground because you're not having another shale revolution. You're just having improvements in technology to extract more that came out of shale. So I don't see this lasting 5, 6, 7 years, and the balance sheets are completely different. That said, from a sentiment perspective, yeah, I feel better from a sentiment perspective being constructive energy, because if you mention it in a room, they'll all look at you and laugh, right? Whereas last year you would have said, well,
There's consensus
I
then.
have 5 other names that are even better than the one you just mentioned, right? Now people will be like, yeah, great, still long energy, move on.
You know, you have had some energy M&A, and talk about, other names in the acquires multiple list. Is in shipping, you had the 2 biggest dry bulk companies merged together today. No one fucking cares, or freaking cares, whatever it is. But that's another point. But again, these stocks are not expensive, and dry bulk's been out of favor since I was in diapers. And so it's just interesting, right? And you need some. I think this M&A is good, right? Just further consolidation of oversupplied industry.
How do you feel about rates from here? Jim Grant had this thing over the weekend that I tweeted out where he said, and I've sort of looked at this. I know nothing at all about rates, but I can look at the rates. Rates are high in 1982, and then they're low in 2022, and that's 40 years, and they seem to move in very long cycles. And that, to be fair, I think that's the extent of Jim Grant's analysis too, that it's a long cycle. I don't think he had anything else in there other than that. But I don't really know what happens here. Like maybe we get some sort of cyclical reason to cut rates in the short term, but it feels to me like rates probably are going up or going back to where they normally are over a very long period of time, and that should change the complexion of the securities market, stock markets, pretty substantially. It's a value trade from there, but there's a lot of motivated
wishful
reasoning
thinking
on my. I like to call it motivated reasoning.
I mean, look, you've had one of the longest ever yield curve inversions. We're going on almost.
Yeah, it is the longest ever.
Yeah, it's like a year and a half now. Yield curve's been inverted.
I prefer the 10-3. The 10-3 has only been since October 25. But yeah, the 10-2 is probably
same thing,
longer.
but it's like, and it's actually, since the rally in markets, it's become more inverted.
Yeah. That was because it was the bull steepener for a while there. The 10-year ran up, and it almost got back to, it normalized by the 10-year running up, and then the 10-year got to 5, saw its own shadow, ran back to 4.3 or wherever it is now.
Some of most of the bulls are laughing at the bond bears and saying, "Oh, it was never about supply." Well, okay, I disagree, but the supply of bonds coming from the Treasury in our lifetimes will never go down, right? Up and to the right, we will have deficits as far as the eye can see, right? It'll be different stagger, but the deficits will never end. That's the one thing you can. Every year we can in our next year preview say, oh, there'll be a deficit this year, right? And so, we're at a point where we're getting to a point where it's got to be a problem, right? And I think this year the 10-year went to 5 because of indigestion.
Yeah.
Right. And you're just gonna keep have rolling periods of indigestion in the market. Whatever they did in the end of October, beginning of November, whether it was the Xi meeting with Biden to change the currency, I don't know. Whether it was Yellen who went short, funded everything the short term, or the immaculate 30% decrease in healthcare costs that drove the CPI down. They had to get bond yields down. They had to.
We're in a screwed up world, right? And
do you think it's real? Like none of this,
is on the one hand, I say to myself, well, rates have to go higher for a host of reasons. One, which Porter just said, which is probably our biggest reason, which is just supply demand of paper. Who really wants to own long duration paper when the people issuing that paper is basically telling you, I'm going to debase you over a 5 to 10 year period. Don't worry about it. I'm going to do it hard too, if I need to. combined with the fact that I think the wage genie is out of the bottle. Like, I don't know if that changes absent a severe economic slowdown. But on the other hand, I say to myself, well, look what happened when the rates were getting to 5.25, 5.5. This world was cracking and it couldn't survive higher rates because we just have too much debt that needs to refinance and roll. And we can't have this stuff rolling at higher rates because profits are going to come cascading down. And it's all collateralized by stuff that is on leverage. And if that happens, then we have a massive deflationary backdrop. So, I'm of the crazy mind of saying, well, rates should go higher, but they need to go lower because if they don't go lower, the world's not going to work.
People forget about all this commercial real estate that has got to roll. Right.
But it just got a helping hand, Porter.
They did, but it's still way above.
But still way above
where they issued it, right? And so, there's either equities are going to have to come to the table, or they're going to have to, extend and pretend or whatever. But the rates are a real problem, and there's a lot of corporate debt coming due as well, and it's going to come, I think, at higher yields than it did before.
So what I think we just had, if I put on my bull hat for a second, sorry, you had the makings and the ingredients of a short-term, let's say short-term 6-month immaculate recovery, right? Which is rates are down 70 to 80 basis points. Let's think like bulls for a second, guys. Rates are down 70 to 80 basis points. The cost of gas at the pump is down a lot. So consumers have a little bit more wallet room. And at the same time, growth is slowing. So I don't have to worry about rates for 4 to 5 or 6 months. That's why I think the market has already priced a good portion of that in. And heaven forbid, which is the saddest thing in the world, if economic activity does pick up after we've had a massive loosening of financial conditions, which it will, I just don't know when, then all of a sudden we have to worry about rates again, which gets back to your point, Tobias, and gets back to Jim Grant's point, I think, is that are we just going to relive the 70s? It just, the 70s is a full decade. It just takes a long time for all of this to transpire. It just doesn't happen in 2 to 3 weeks because we're thinking about it right now of how it's going to play out. So,
that said, we are fully cognizant of the fact that the government is trying their best to get, for all of our sakes, the interest cost down. Yeah. They got a big problem, and they're going to need interest rates down because their costs are exploding on them. So, I think it's going to be a battle.
Inflation does seem to have come down, or, but putting aside that 34% reduction in healthcare costs, that was necessary. That was good timing. But inflation seems to have come down. That might justify lowering rates a little bit. But then somebody made the comment in here. I just lost it a little bit at the moment. But if Powell sees the stock market's at all-time highs, housing market's at all-time highs, what incentive does he have to cut at this point? What reason would he have for cutting?
He doesn't. And that's why I think gets back to Porter's point, in that I think the market started pricing in way too many cuts, given the fact that given the structure and the leverage associated with markets, we priced in a recovery and just bypassed any slowdown fairly quickly. Maybe he has 25, 50 cuts before we go into a presidential election cycle. But it's hard to see the cuts, given the data that we're looking at right now. It's hard to see the cuts people are expecting. And I assume tomorrow, because we're taping this on Tuesday, it's Tuesday, everyone's live on Tuesday. Tomorrow, he's going to try and give a message, I assume, that we're not cutting anytime soon and we could tighten as quickly as we can cut. I'm not necessarily sure if the market is going to believe him all that much. We'll see.
JT, you looked at the inflation in the 70s, just those attempts to raise rates, and they always came off too quickly. Do you want to talk about that a little bit?
Well, my observation from doing some research around that was that just trying to like put myself into like the lived experience of sitting there day to day and numbers coming in and there were multiple waves that happened years apart, and you had to have thought like, oh, we're on the other side of it, like we've conquered it, where um like oil's gotten put back together now, like everything's good, and then it just came back with a vengeance and it got even worse. And I don't get the sense that people are really thinking in that kind of that things could get worse. Like that seems like a lot of Pollyannish sort of bias to me, but
Yeah,
I
again,
just have
no one believes that inflation is going to really come back. I think there are a couple of us probably that are higher for longer, but I don't think the market really believes it's going to reaccelerate here.
There's also, the proverbial lines, the stock market ain't the economy, right? Well,
yeah.
Main Street inflation ain't Wall Street inflation, right? By any stretch of the imagination. I mean, you speak to some friends or just look at your own wallet, right? My expenditures are probably up in price this year. And I think everyone else, 10, 20%. I mean, I joke around on Twitter a lot that the CPI doesn't calculate any of the crap that it needs to. That's a normal. I mean, anyone who looks at their auto and home insurance, and and the other great Wall Street definition I love is that when people, inflation's up, let's say from COVID to now, 30 to 50 to 60%, but because we're only up 3%, inflation's killed. So let's knock down rates to 2%. Yeah,
Right.
the cost of living
Cumulative.
has just jacked up. And it's jacked up for everyone, whereas the wage increases are a little bit more fine as to where people have improved on their wages. Most have, but not to the extent that prices have gone up. So yeah, I'm kind of with all you guys that I think I'll say it for myself. I think we probably relive the 70s because I think we're going to have we kicked inflation and do the aircraft carrier. And as long as you don't if you're not getting rid of this liquidity in the system, it has a high potential to come back, and it's going to feel bad if it does, particularly when Main Street inflation starts translating into Wall Street inflation again. But I think we're a few months or several months off from it.
And I'll piggyback on what Vinny said earlier, is that it's going to be a very odd year because of the election. I have to think that the Federal Reserve doesn't want any part of Trump, right? How many times has Biden criticized the Fed?
not that I've heard. Yeah, not that I know of.
And Trump was in there every day saying,
Oh,
"What are you
right.
guys doing?"
Yeah.
With everybody else.
like,
I'm a low rates guy.
yeah, they don't want any part of Trump. And you're like, oh, poor, that's going to get political. Yeah, of course it's going to get political, right? So the Federal Reserve wants no part of Trump.
What does that mean? They juice like as much as they can, like adrenaline shot to get the patient through the election cycle.
Let's take
People have to be more cynical rather than less cynical, by the way. People aren't cynical enough about this shit.
Let's take another path, right? Because I was actually at a dinner about 2 months ago, and it was with a bunch of, let's call them old Reagan Republicans, right? And the dinner was in New York. And they were talking about how big Republican money is stacking. And the first flavor of the week was DeSantis, but now it's Nikki Haley, right? And they're doing everything in their power to overthrow Trump before the primaries. Well, let me give a what if, because this is where my stupid brain goes. What if Nikki Haley, what if the oligarchs win and they get Nikki Haley in, even though Trump is winning the primaries? What happens to 35% of the population, the cult that follows Trump? What happens to this country from a society perspective if they feel like their guy is getting not a fair shake? And again, I'm not putting a high probability outcome on that, but it is a path. What if Trump is the nominee, which it looks like the polls are suggesting it is? And anyone who's listening, I'm from Queens, just like Trump's from Queens, but I do not like him, right? But I'm just looking at the polling and saying he's going to be the Republican nominee. And the polling also strongly suggests that he has a good chance to beat Biden. Like, what happens to markets as that manifests? I'm not saying it's bullish, bearish, it's just volatile.
Well, Vinny, if Nikki Haley does
Yeah.
beat Trump, the market's going to fucking rip.
I agree.
Rip.
And because she has a very good shot of beating Biden. So this is where I think
she's going to crush Biden. Like, Biden doesn't have a shot. If the only votes Biden get are anti-Trump votes.
Correct. That's my view. But so I just think the election is going to be a volatile creature that we're going to have to deal with. Probably works well for your virtue, by the way.
And the Supreme Court's going to get the Supreme Court's going to get political too, by the way, because there's all these Trump court cases coming. Do you think they're going to wait? Because Trump's whole strategy is push him out to the election or past the election. I'll win the election and I'll wipe everything clean. I'm good. Right. So the Supreme Court, if they say, "Oh no, we're going to hear these cases before the election," it changes the election. So I think that people need to be more cynical about all this crap that's going to come down the pipe this year.
And how do you have VIX at 12 with all this?
Well, that's exactly where I was just going to go. I don't know what's going to happen. I just think that there should be more volatility, but we've seen VIX's squash. JT and I were talking about this before we came on.
I think that's more, institutional money managers like suppressing that's the output of all these vol funds together, and they suppress vol. We're back to looking at this at 12 today, right? It's back to pre-pandemic levels. Like you took pandemic out of the picture, and you're back to 12 vol. And so, I don't know. I don't have a great call on that, but
what that does mean though, just in general, just in terms of how markets work, because aside from passive ETFs, the other big elephant in the room that dominates markets are the vol targeting regimes. So just by definition, if volatility is low, the gross capital notional deployed by these vol targeting regimes is extremely high. The lower the volatility goes, the more capital they deploy, generally speaking. So that leads me to believe that volatility is probably severely underpriced. Again, when that manifests itself, I don't know. Like you can't time it. It's just that when you have that much capital coming and an election, I would want to be long volatility. And it could be that markets go up and rip. Generally speaking, they don't. I'm just saying that I think volatility will at some point in 24 be on a material rise from where we are right now.
I saw that you could hedge a long book of SPY for like 6% for a year, something like that. Just seemed crazy cheap.
Yeah.
What do you think is causing the volatility? Is it those 0 day to expiry options, or is it Jake sent through an article that said it was the covered call strategies have gone from being like 3 billion to 60 billion over the course of, was it 12 months, JT?
Yeah, I think it was like year to date or something. Huge.
That stuff is way too above our pay grade in terms of the options market. I kind of wish I knew it better, because every time you think the market's going to go down, like the VIX sellers come in and market pops, and I think it's the tail wagging the dog, more so than the other way around. Right?
I also think keeping it simple, the way I like to think about it, and this is shockingly a bit more cynical. I think the market has figured out that the Fed really has no teeth. Like when we get to the 2-3 standard deviation events, the Fed blinks every single time, and people notice that, right? And so all these structured shortfall strategies get more and more comfortable knowing that at a certain point, the non-bank, too big to fail capital markets ecosystem is too important to the system to allow Powell to show some real teeth and go through price discovery. And that's what I think we've seen time and time and time again over the last, it's not just 2 years, but 5 years, that the Fed will blink, and they do. They've gotten better at not blinking explicitly, right? Whereas I think, I'll give Powell credit under the Biden administration. He doesn't blink explicitly, but it's implicit. And the people who are in the know that it's an implicit bailout somewhere, somehow. And that's why I think volatility just continues to cascade down.
When you guys say you get a market rip, one of the I look at we've already got stock markets almost back to where it was 2 years ago. Housing markets up. Where does it all go? I mean, we've had.
By the way,
I don't
know that the housing market's back to where it was before. You've had a lot of.
I think the single family housing is sort of where it was.
Not in units, though. Not in units.
No, but in prices, he's saying. But I think a lot of it is new home sales and the builders, the mortgage buy downs. So there's a lot of it sort of odd. The incentives are in there, but if the average person goes to sell their house, I don't think it's anywhere close to where it was at the peak.
No.
Depends on the price level, obviously. Especially the upper end, I think it's tighter, or it's harder. There's more like, sort of call it there's nothing like 500 to 1.5 million. I think that moves better, but the higher you go up, the less it moves.
When we were chatting a couple of years ago in Newport, we were talking about, sort of this expectation for a flush. Like, you would probably need a flush to clear this market at some point. We really didn't see that, even though we had 2022 was very weak. And now we sort of rallied back, which I would have said was pretty classic bear market behavior, where you get the weakness and then the rally. And then after that, you finally get this, people realize that nothing's been fixed, and the market flushes.
I mean, maybe that was the flush.
Which one?
The
SVB.
Yeah, or the end of
22.
The end of 22. The
October
markets were down
22.
a lot.
Do we get down 25%, peak to trough, something like that?
Yeah, I mean, Apple got down to 20 times. Is that cheap? Maybe. But now you're again 32 times. Like what and I think a lot of China risk in there, in terms of competition coming in, and so I don't know that's great. That's not where I think you want to add money, and I think that. I can just look at the Apple versus the Qs or Apple versus the XLK. It's starting to underperform here. Top
What about
heavy.
Nvidia? Nvidia looks pretty strong. They've been growing at exceptional rates, but there's a few YouTube videos floating around suggesting there's a little bit of channel stuffing going on, or they're funding some of their customers.
What's the stat about I think 2 or 3 customers are 30% of sales?
Well, yeah, but a lot of them are the typical customers you would know that would be 2 or 3, but it is a very concentrated revenue stream. That said, I mean, look, I was at a conference the other day, and a bunch of idea pitches, and I would say a quarter of them were AI related, right?
Yeah.
So it is clearly
long and short, though.
Long and short, but it's clearly the growth element of the world, that, and I guess getting thin with Ozempic. So, I tend not to like to quarrel with secular growth stories or long-term cyclical growth stories, because just money of all kinds flocks to it, whether we like it or not, regardless of valuation. It doesn't matter. The only counter I would have right now is that you've got a really low VIX, you've had multiple expansion. The flows into markets are going to be, they're probably going to be decent, but I don't know if you're going to see a massive positive rate of change. And a Fed that probably can't cut as much as people would like them to cut, regardless of what's happening to the economy. So there are challenges and headwinds coming in 24. We'll see if the market recognizes them or not. We'll
You
see.
think they do some token cuts just for the just it looks good. You're starting to cut, even though they know they can't really cut too far.
Possibly.
Possible. Possible. I'm
No.
not ruling it out.
Is
No.
that enough to juice the? Is
Well,
that enough to get the patient through to the end of the election?
Who's
Yeah.
the patient?
the economy.
The economy? Yeah, maybe. And let's just go down the conspiracy theory of
Yes,
What-
let's.
what if Trump's the nominee? Do you get more than 50 or 100 bits?
What if Trump's the nominee and he's also been convicted of, or I don't know how much of it is criminal, how much of it is civil, but if he loses it, so he's under he's incarcerated and the nominee.
I mean,
Really,
What if he's
really-
incarcerated and the president?
Full banana republic achieved.
Jake and Tobias, I'm really, really not looking forward to this presidential election. As an American, it is not, all of these paths to me are possible. And it's all nasty because there are cults on both sides of the equation that are going to go ape shit.
it's more annoying. The day-to-day, when he was president, it's the day-to-day watching of his Twitter to figure out what he's going to do with markets. Like that was the more annoying thing of like, oh God, I gotta listen to this guy actually.
I thought there was before the whole cycle started, I thought there was a reasonable chance that we'd have 3 presidents in a very short period of time, because you have Trump going to Biden, Biden hands it off to, maybe Newsom or someone like that. Maybe Newsom loses an election and then it's the next president, like that kind of, and that's been, that volatility or that quick changeover in leaders has been common in other countries around the world. Like that, Britain has done that repeatedly. Australia's done that.
I mean, frankly, I'd be pretty happy with Nikki Haley as a president. I mean, it's about time we have a woman president, and I don't know. It just feels like America needs a change rather than these two donkeys running things.
Yeah, it seems the only options are Biden or Trump, who we've got, just
Yeah.
based on the polling.
The sad thing is the polling would suggest we're not going to get our wish porter, which
I
is
know.
the change element. I was at another conference where it was more left-leaning and influential, and they felt like Newsom could not win an election because he could not carry the flyover states. Like in California, a Democrat cannot carry the flyover states.
No.
So you would need somebody different. Who that is, other than Biden, don't know.
Get a good running mate. Is that enough?
No, no. But, and here you think about certain, we've talked about a lot of probabilities and non-committed stuff during this podcast. The one thing I'm fairly certain of is that we could criticize Biden for a variety of different things. But the one thing he knows how to do is win an election. And I'm not even talking about crooked stuff that is alleged and like. I'm talking about he's going to spend money like a drunken sailor, like he did this year. Bidenomics is basically 6 to 8% fiscal deficits.
Yes.
Right? And just plow over every other issue that is, and pray to God the bond market doesn't call you out. And the bond market.
But I would say, Vinny, though, it's unlikely that the fiscal impulse is going to be as strong in 24 as it was in 23. That's why it goes back to, that's why I don't know that that the S&P earnings are going to be 11% like the market thinks it is. But with inflation coming down,
Well, Biden might just tell you, hold my beer, right? Because the last thing he wants to do is lose to Trump. The last thing in the world he wants to do is lose to Trump. So I'm with you, Porter, and the math, the math gets really hard and it gets difficult, but we're going to spend a lot of money next year as well.
Yeah.
So.
What's your read on the economy with all of the deficit spending is material? That Inflation Reduction Act is clearly massively stimulatory. You've got the consumer seems to be in pretty good shape, but all of the metrics that I've got this little running thing on my Twitter page where I just grab the negative prints, and it just seems like businesses are in a little bit of trouble, particularly small businesses, all seem to be shrinking, and that all of the statistics look as bad as they go back to sort of depending on where the data starts, 1995, 1965. How do you reconcile those two?
Well, I mean, you look at corporate bankruptcy filings,
Yeah.
right? It's I actually think you're going to see if you look at the chart of the bankruptcy filings, post pandemic it dips. I think you're going to see a reversion to the mean upwards of clearing not only all the crap from the pandemic, but the higher rates are going to kill a lot of business as well. So, I think things are going to be, very uneven, the next year and a half.
I think that's the key word, uneven and mixed.
Yep.
Maybe that's what we've already seen.
Yeah.
Maybe that's why.
But the bankruptcies, like, there's going to be just a natural reversion to the mean, right? Because there's a steady state of this stuff, and I think there's going to be a lot of cleaning out of all this, pandemic era businesses, and there's just a lot of crap. Right? Just like all these SPACs and
Plus office is 50% occupied, and really the occupancy is 50% of the 50% because nobody's offices full.
I think that's going to be a rolling 5-year issue.
Agreed.
It's been amazing.
Rates are not low enough to clear that stuff right now. It's just that so that's going to be. I agree with Porter on that. We track consumer delinquencies and charge-offs on a monthly basis through the big card companies, and what you're seeing right now is a path to normalization. We've had incredible consumer credit for quite some time, right? For a long, long time. So it's really difficult to say that we're going into something catastrophic, as opposed to if you go further back into the charts and look at further years out, you're just getting back to normal, which is a return to normal. On the other hand, if you're an employee that's living off the government, if you're a healthcare worker, you're feeling pretty good right now. You're not in bad shape.
The funny thing about some of the underwriting over the past couple of years, the banks have been pulling back. Maybe it's because dumb luck and they had trouble funding, but there's been a lot of guys, these fintech lenders they've been with no experience, lending very aggressively.
Yeah.
So
I now pay later.
Yeah. Listen, that's going to be one of the most interesting case studies, because if you look at the volumes of a firm right now, the buy now, pay later, they're off the charts, right? And if you're doing business with Amazon and Walmart, you're not getting a good deal, right? Amazon and Walmart are doing it to drive volume. They don't give a crap if the credit goes bad, right? They already bought the G.I. Joe, right? And so I think you're really going to have a interesting case study of what happens to this stuff next year, right? And there've been a lot of aggressive debt consolidation loans, and you've just seen huge growth in a couple of these companies. It's going to be very interesting how it turns out. My guess is not well, but we'll see.
I think it's one of the most confusing mixes of economy, market, rates, politics that I've ever seen.
I would agree. Yeah.
I agree.
And so, you go back to, what do we own? We own very idiosyncratic, cheap is always the bottom word. And about, I wish we could find some of these compounders. We talk with one of our good friends, and that's what he looks for. He's like, I can't find them at the right price here. And so, we see plenty of value. The question is, can you get, some commodity movement, or can you get some inflection in some of these names and to keep working? So, I like where we are, but, shorts haven't worked this year at all. They've been terrible. I do think the shorts will work better next year. That I'm actually fairly certain of. It's been so bad this year. So I think the shorts will work better. if that makes sense. And some of the value longs will be okay.
And on that note, gents, thanks so much. Vincent, Daniel, Porter
Yeah.
Collins, Seawolf.
Great stuff.
Awesome.
Good seeing
We'll
you
have
guys.
you we'll have you guys on again in the first quarter next year, just to call you out on all of the
And hopefully
just
you're
to see how you
zigging in the
feel.
right direction.
There we go. Let's hope.
Exactly.
Yeah.
Thanks, fellas.
All right, guys.
Thanks, everybody. We'll be back next
Have a
week
good
for the
one.
last one of the year.